All right, this is the really fun stuff in this class, because I was amazed how much companies still really do this in real life. So this isn't just like, learning something for Finance 300 because you've got an evil professor who tries to find like boring stuff or hard stuff to look at. This is what companies use day in and day out when they're trying to make investments and trying to figure out what they should do with the money they have that they're going to reinvest back in the business. So how do they decide whether or not to reinvest money back into the business? And this process, it actually varies a little based on the size of the company, okay? And here's some results from a poll. These are some of the techniques or calculations that chief financial officers, CFOs, might use to analyze an investment project for a company. And we'll look at these in a little while here, but we've got NPV. That's the first one in blue right here. And NPV stands for net present value. We'll talk about that. Then we have IRR in yellow. IRR stands for internal rate of return. And we'll talk about that, but you've already seen it. Do you remember that funny word called CAGR, C-A-G-R, compound annual growth rate? Well, it's very similar to internal rate of return. And so, so that won't be entirely new for you. And then we'll look at, in red here, payback period. And then we'll also, we're not going to spend as much time on the last two just because they're not used quite as much, all right? But what this shows you is the popularity of these different techniques. And by far and away, NPV and IRR are the two most common techniques. And I can vouch for that. It's what I've seen. I've worked for two big companies and multiple divisions of both of them. And I've done some consulting with some companies here in the Bay Area. And, they all have different shortcuts they make or assumptions that go into it. But NPV and IRR are definitely the most popular methods of evaluating projects. So it doesn't matter if you're going to go into operations, if you're going to go into marketing, if you're going to go into accounting, finance, who did I miss? Economics, human resources, maybe not as much, unless maybe you're you go up higher levels where they're looking at labor costs and stuff like that, and they may want to get estimates for you to put into this. But there are definitely labor costs and stuff like that go into this, and definitely IT too. In fact, I did some work with a company called Safeway, and they have to invest tons of money in IT infrastructure because all their stores are running like all those transactions all day long, and so they have huge investments in computers and vendors, and so they do a lot of this in terms of analyzing NPV and IRR for all the costs that they have to go through. So this is pretty legit, this stuff. I think it makes it kind of neat. So maybe someday when you're working a business, you'll be like, yeah, I covered NPV and IRR. So let's take a look at it. NPV is just defined as the initial investment of a project taken as a negative cash flow plus the present value of all future cash flows. Right? We've already done the present value of multiple cash flows, and so we're kind of already there. The only thing this formula really adds is the initial investment at time zero, because that's the way most projects will work. You have to invest some money at the very beginning. Usually we define that as time zero. And then at some point in the future, hopefully you start either making positive cash flows back or you start saving money. And so we usually have this negative outlay of cash flow up front, your investment, and then positive cash flows coming back to you later on over time. And so we want to analyze these cash flows to see whether or not it's a good investment. This is what the equation will look like. And usually this C0 right here, the cash flow at time zero, that's usually going to be negative. And then these other cash flows, C1, C2, C3, all the way on up, those are the cash flows at any point in time in the future. And those can be either negative or positive, okay? And time period T out here, that's just the year. And so we take the present value of each of those cash flows. And R is, referred to as the opportunity cost of capital or the discount rate. This right here is the initial investment at time zero. And then over here, these are all the present values of all the future cash flows until the very end of the project. And so just be flexible about the cash flows and whether they're negative or positive. They can be either one. Don't get worried about it if you get a surprising negative cash flow like at the very end. Sometimes projects have that. When they shut down, they have to spend money to close up a certain project. And so positive, negative cash flows can happen all over the place. Yeah, so you notice, like I said, the negative sign here. So by convention with these NPV calculations, what we always do is we define an investment where you have to pay out money as a negative cash flow. And a positive cash flow is defined as like sales coming to you, profits, that type of thing, or even savings. So money you're making is positive, and money you have to pay out to someone else is a negative cash flow. So we go ahead and we calculate the NPV, okay, for our particular project. Here's some of the rules. You invest in projects that are worth more than their cost. And what that means is that they have an NPV greater than zero. So if you have an NPV equal to zero, what that means is you basically have no profits at all when you take into account the required return from your investors. There's no excess profits at all. So what we usually say is NPV has to be greater than zero. We want some extra profits in order for us to invest in that project. So we're looking for an NPV greater than zero. If it's $1, then that's a go, and we invest in it. If you're comparing two different projects, we take and it's only one or the other, you take the project with the higher NPV. Okay? So pick projects with a greater than zero NPV, or pick the project with the higher NPV. Sometimes you might have projects like that you're required to do for legal reasons. Like say you have to put in, I don't know, safety measures for COVID in your business. You'll do an NPV analysis and maybe it won't look very good, right? Because you're not saying that it's going to do more, bring in more business. Maybe it's just going to be a cost that you have to incur. So sometimes projects will have a negative NPV, but companies will still do them because they view it as a part of having to stay in business, that they don't really have a choice. Okay? So that does happen sometimes. that NPV projects that have a negative NPV are done, and it's usually for like safety reasons, legal reasons, or environmental or regulatory reasons, where companies kind of have to do it just to stay in business. So let's go ahead and do an example here. And I will, I'm going to start this in Excel. And you can go ahead and why don't we all work on this after we read the problem. You have the opportunity to purchase an office building for $350,000. You have a tenant lined up that will generate $16,000 per year in cash flows for 3 years. And at the end of 3 years, you anticipate selling the building for $450,000. Should you invest given a 7% discount rate? So think about that for a few minutes and see if you can plug that into your NPV formula. And we'll come back and we'll work on it together. So go ahead and check that out, and I'll give you about a minute or two to work on it. Okay, so here is how I would build it. Now, one of the good things is it's kind of like good practice for spreadsheets, is that you kind of put your key assumptions at the top on the left of the spreadsheet. And one of our key assumptions here is 7%. Okay? Because a lot of times these are key assumptions, if we link to them in our spreadsheet, we can easily change them, because you'll go into a meeting and you'll look at the financial analysis and people will always ask what if questions. Well, what if we're able to get really cheap loans on this project such that our opportunity cost of capital is much lower, or required return from our investors is lower because we can get really cheap financing. So then you could recalculate the NPV quite easily just by changing this discount rate up here. And as long as everything is linked to that in your calculations, it's easy peasy. So let's write down all the cash flows we're going to have. So we're going to have the building purchase, and then we'll have rental cash flows every year, right? And then we're going to sell the building at the end. And then we're going to go ahead and calculate the total cash flow every year. So this is a good way to set it up. So let's put in the building purchase price. And we're told that it's $350,000, right? But here's the deal, right? We want to make this a negative cash flow. So let's put in a minus sign in front of it, because it's money that we're paying out to buy the building, okay? That's at time 0. And then we're told for the next 3 years, we have cash flows of $16,000 per year. So that means it looks like this, okay? And then at the very end, we're going to sell the building for $450,000. And so selling it, so that's going to be a positive cash flow. That's going to put money back into our pocket, right? So those are all the cash flows. And now to make the NPV calculation formula easier, let's sum those up. So we're just going to take the sum of the cash flows. And we could do it like this. This plus this plus this. And if we do it such the way it's the same, it's going to be the exact same in every column, then we can just go ahead and copy and paste the formula all the way across. And the easy way to do that is you click on the cell where the formula is, and then you see a little square at the bottom right there, right here. You click on that, and then you drag the formula all the way across. And it automatically puts the formula in. So there we go. And so you can see there's the formula. It's E4 plus E5 plus E6. And just making it so it's the same formula all the way across makes it easier. Even though we don't have anything for building purchase there in year 3, it's okay because it's basically 0 if nothing's there. So it won't change our formula or make it wrong. Any questions on setting up the spreadsheet here? All right, then let's go and calculate the NPV. All right, what should I do first in the NPV formula? What do you guys think? How do I handle this at time 0? Do I need to take the present value of this minus $350,000? Give me some yeses or nos in the chat. I see some no's, right? Because it's already in time 0 means we don't have to take the present value of it, right? And so this is kind of weird. Basically, the NPV function in Excel does not have year 0 in it. That means we have to add in the cash flow at time 0 by ourselves outside the NPV function. So it's going to look like this. So that cash flow plus, then we do our NPV, the discount rate, right? And then comma, every single cash flow. That's it. Every single total cash flow. So that's how we would set up this problem in Excel. I kind of like it doing it like this because I think it helps, it makes it easier to visualize it. So we don't have to get kind of soaked in all the divide by 1 plus r to the power of t. But we can do that still. Any questions on this NPV setup for this problem? Let's see what answer we get. Whoops. It looks like it's in percentage format. Anybody not sure if they got a different answer? Not sure why? Okay. All right, let's go back to the slides then.
So the original question was, should you invest given that 7% rate? So I guess what I'm confused on is we got to the final net present value answer. How do you make your determination from there?
So right here, look at this rule on the previous slide. You invest in projects where NPV is greater than 0. And so the answer we got was $59,323.
Okay, thank you.
So what's the answer? Do we invest?
Yes.
Yeah. Yeah, so the answer is yes, invest. It's $59,000. So and what that represents is we've kind of paid off our investors what they require, and we got an extra $59,000 in profits. That's kind of what it's saying. Because that discount rate should take into account what we're required to produce for our investors. All right, here's a follow-on question. What is the maximum you'd be willing to pay for the office property? Well, think about the rule that we looked at 2 slides ago. Right here, we invest in the project if NPV is greater than 0. So let's just say that we were willing to invest in the project if the NPV is equal to 1. So that's the minimum NPV we would take. That's what that rule says, right? So at what point do we get an NPV equal to $1? That's what this is asking. Where do we get what's the purchase price that gives us an NPV of $1? I'm going to go back to the spreadsheet. Right, because you might, this kind of question will come up because, you know, purchasing an investment might be a negotiation process. It's not like buying something on Amazon. This is like, you know, you're making an offer through a realtor and you don't know if it's going to get accepted or not. So how much should we be willing to pay? And so what would the purchase price be that would make this NPV equal to 1? Now, one thing we could do is we could just take this NPV right here and kind of subtract it from the building purchase price, because that's what you're doing, is you're kind of giving away all your net present value, all those profits, if you pay more for the building. If you don't want to think about how to calculate it, we could just keep upping this purchase price until we get a number that makes this $1, right? So I could do this. Let's say with $400,000, would that still give me an NPV? Oh, it needs to be negative. I'm sorry. Okay, so if we pay $400,000, now we only have a $9,000. What if I pay $409,000? Oh, now my NPV is $323. I can pay a little bit more. Let's say I pay minus $409,322. There we go. $1 NPV. So $409,322 is the maximum we'd be willing to pay, because if we pay any more than that, right, the NPV is going to start going negative. What if we pay $420? Now we got a negative NPV and we're not willing to do that. Okay. So 409,322 gives us a $1 NPV. So that would be the answer to that. That's the most we're willing to pay for the property, because when you pay, it's a negative cash flow. And the more you pay, the lower your NPV. So let's talk about how this NPV takes into account risk. Because what if you had 2 projects and one was a lot riskier than another? Let's say like you had one project that would give you a payoff of $1,000 if you could figure out how to walk to Reno, right? And another project would give you $1,000 if you could figure out how to walk to Hawaii. Well, I would say one's probably much riskier than the other, right? And so they shouldn't give us the same NPV, those two projects. Even though the payoff in the end is the same, $1,000, because one's a lot riskier, somehow that should be taken into account, right? And so where this gets taken into account is the discount rate or the expected return. High risk projects will have higher discount rates. The expected return of our investors will be higher for something that's really risky, right? Because there's a chance it won't even happen. So to compensate investors for the chance that something won't pay off, we have to promise them the possibility of a higher return. So it's kind of like when banks lend out money, right? They look at the credit check on consumers, and a consumer with a lower credit score may have to pay a higher interest rate on the loan because there's a higher possibility that they won't pay it back. And so the extra return that goes with extra risk compensates investors for the probability that you won't get anything at all. Okay, and this kind of, it kind of works when you look at a lot of projects. Banks look at a lot of consumers when they lend out money. So they're kind of playing the averages. They know of people with a really high credit score, only 1% default and don't pay back. And so if they set the interest rate at like 5%, they can make their profit. But now if they send out loans to people with a very low credit score, and 20% of those loans, those risky loans, default, they have to charge a higher interest rate to compensate the bank for all that 20% of people who didn't pay back the loan. So they're usually kind of looking at this from a big picture point of view in terms of how many potential people they will get and what they have to charge to compensate for that risk. And so this is what we do with NPV calculations. We use a higher interest rate in the denominator of our present value calculations. That discount rate, the required return of investors, is higher for riskier projects. So here's the thing though, right? And this kind of makes sense. When we do increase that interest rate, that discount rate, for the same set of potential cash flows that we're going to get in the future, the NPV will go down. And that's kind of what we want to happen, right? That way, if a project has certain cash flows, but it's very risky, the NPV goes down, and now the project does not look quite as attractive because it is risky. So we do have risk built in to the NPV calculation, and it's through that discount rate. So let's do an example. What is the NPV for that previous problem we just did if the discount rate was raised to 12%? I'm going to go back to the spreadsheet. So I'm going to go back to the original purchase price we had. That was $350,000, right? And we had, at that time, we calculated NPV of 59,323. So now let's go ahead and change this discount rate up here to 12%. Now what we should see is if the discount rate goes up, NPV goes down because it's riskier. It doesn't look as good, right? And that's what happened, right? So now our NPV is $8,700 instead of $5,900 something. So that's where risk comes into play. The cash flows we put in here, those are all expected cash flows. Okay, it's what we expect to see. And if there's concern about risk or anything like that, that goes into this discount rate up here. Okay, so that's NPV. And let's talk about IRR now. IRR stands for internal rate of return, and it is related to NPV. IRR is the discount rate that makes NPV equal to 0. That's interesting, huh? And so there's a couple rules we have for IRR. You invest in any project that offers a rate of return that is higher than your opportunity cost of capital or your discount rate. And if you have to choose between projects, choose the one with the higher IRR. But there are some problems with IRR that make NPV preferred. Okay? So NPV, bottom line is a better way to measure investments than IRR. But the problem with NPV is you get a number like we saw, $59,000. People are like, well, what does that mean, $59,000? I get a project I'm going to run over the next 10 years, and you're telling me it's only worth $59,000? What does that mean? So people have a hard time visualizing what NPV means. Okay? We know it as the cumulative dollar profits above our opportunity cost of capital, what investors require. IRR is a little easier to understand. It's your average annual return on your investment. That's it. And it's really easy for people to understand. And if you give me a good high return, I'm going to say, heck yeah, let's do it. So let's take a look at how to calculate IRR. And I think this will probably be the last slide for today. So you can purchase a building for $350,000. This is the exact same example we just did before. The investment will generate $16,000 in cash flows during the first 3 years. At the end of the 3 years, you'll sell the building for $450,000. What is the IRR on this investment? So notice I took the net present value math calculation here. Over here on the left, I set NPV equal to 0, and then I left the R as the variable IRR. So what we're going to do in this problem in calculating IRR is we have to compute what IRR is. And I don't know about you, but that looks like a pretty nasty math calculation, right? Because we got IRR down in the denominators, and we have them to different powers. And there is no good way to calculate this. So what we have to do is we have to rely on Excel, or if you're using a financial calculator, we can use that as well. Otherwise, we have to use the iterative approach where we guess a number for IRR, we do the math, and we try to get the right-hand side of the equation equal to 0. And we keep changing it until we get it to equal 0. Right? So let me show you how this is done. Now check this out. I can keep the formula I have up here, and I can keep changing this discount rate until I get NPV equal to 0. So watch this, 13. Oh, that's pretty close. 12.5. Oh no, that's further away. 12.7. That's getting there. 12.8. Getting there. 12.9. 13. Oh, so it's somewhere between 12.9 and 13. You can see how this is kind of a pain in the neck. 12.6, 12.96. Wow. Wow, so you see it's very sensitive here, right? Well, that's about as close as I'm going to get. And you can see what I did as I got 12.961. Now, you don't want to have to do that, right? So let's go ahead and calculate IRR like this using the IRR formula. You just do that, IRR, and then the way you do it is you highlight the whole range of total cash flows like that. So our cash flows are B7 through E7. And I'm going to increase the number of significant digits on here so we can see what happened. So it's 12.9609. That's how IRR works, pretty simple. Now, some of you are probably wondering, why can't I do this? Now, you think you should be able to do this, but the last time I ran Excel, and unless they did an update within the last little while, you couldn't do this. So let's see what happens. No. So unfortunately, IRR only works when you link to the cells where the numbers are. I'm not sure why that is. It's a little bit enigma. But so this is how you're going to have to use the IRR formula. You point to the range where all the cash flows are, starting from 0 out to whichever year you forecast. Okay, so that's it for today, everybody. I hope you have a great week.